Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. This week saw perhaps the last US rate rise in this cycle. So we now need to ask ourselves whether central banks are finally winning the war against inflation. Certainly the headline rates look set to decline as energy prices flow through into the wider index, and food prices too look to have peaked, with wheat prices now at 2-year lows. Core inflation, though, is more problematic. Prices are still sticky, and it's a long way back from today's rates of 5.5% to 6% in Europe and the US to the 2% rate targeted by the world's central bankers. Risks, I'm afraid, still remain tilted to the upside. Wage costs are now only beginning to moderate, labour markets are tight, while European energy prices are still vulnerable to a cold winter. In addition, it appears that companies are still pricing aggressively. Get used to the new phrase, greedflation. So yes, we're slowly winning the war, but it's still a long journey ahead for central bankers. Let's look at what this means for your portfolios in the slides ahead. So let's begin with our regular review of world markets for the year to date. Global equities up 3% in sterling terms, that rally fading a little bit. UK gilts broadly flat for the year to date. The dollar continues its month-on-month declines. Oil surprisingly weak given the recent OPEC production cuts. West Texas Intermediary down below $70. And gold, the star, continuing its 2023 ascent. So let's now focus back on that inflation question we were talking about earlier. Looking first at headline rates around the world, the UK stubbornly high at 10.1%, quite substantial falls in the euro area, and US headline rates to 6.9% and 5% respectively. That rate in the UK should start to emulate those and roll over in the months ahead as the cost of gas and electricity and other household utilities begins to fall on a 3-month basis and flows into those underlying numbers. Core inflation rates on the right much more tightly grouped, showing no signs of any substantial fall yet. Indeed, that dark blue line, the US core CPI, actually up month on month. So what's behind that stubborn core inflation rate, and can we expect it to roll over in the months ahead? Well, I think the first reason of some optimism for this is that the central banks, yes, they've deployed a lot of interest rate tools, 10 US rate rises up until this week, but they haven't yet embarked on unwinding their vast COVID-era balance sheets, with QE only turning into very modest amounts of QT. You can see that black line only going marginally negative. That programme will accelerate in the months ahead and will tighten credit conditions globally. On the right-hand side, we looked at the Senior Loan Officer Survey before. This is how tight loans are, the loan conditions are issued by commercial banks across the US. That beginning to rise, we see that climbing further in the aftermath of the regional bank crisis in the US, which I'm afraid is not yet over. The second factor that I think will be supportive of lower core rates is the beginnings, at least, of a rollover in wages and labour costs. You can see there the best measure, I think, for the US economy, the Atlanta Fed wage tracker, beginning to roll over to somewhere around 6.4%, admittedly a small fall. On the right, the labour market showing some signs of easing up. Those colossal vacancies right across the US economy that swamped the pool of available labour, beginning now to roll over, falling from a peak of more than 12 million down to 9.5 million today. Similar figures evident in the UK and in Europe. Thirdly, we need to look at company behaviour because in some ways their input costs have been falling really quite substantially. I've plotted the annualised rate of the metals, industrials and food indexes produced by the Economist magazine. They're falling by 15, 21, 24% year on year. But yet the prices paid by US companies at the factory gate are still continuing to rise. From the famous ISM prices paid survey, anything more than 50% is rising prices, and you can see services at 59.6 and manufacturers at 53.2. So companies appear still to be protecting their margins. As one respondent to the survey said, pricing pressures continue to plague daily operations. Expect more talk of a new term, greedflation. This idea that companies are not passing prices on, it's going to become a very hot political issue. Fourthly and finally, from a UK perspective, a lot of our own inflation pressures are imported. Now, in our previous reports, we've talked about a stronger sterling, and I think this will have a big mitigating effect. In last week's talk, we looked at the sterling trade weighted index and how it tended to fall sharply in geopolitical crises and then climb steadily thereafter. After the fiasco of the Truss Quartet mini budget, we think the Sunak Hunt team is much more credible and can lead or be part of a rally in sterling. In addition, interest rates are moving more in favour of currencies other than the dollar. I plotted the 10-year government bond spread between the US and UK. A year ago, the US 10-year bond yield was 1.5% above the UK. Today, it's 31 basis points below. So there's interest rate differentials in favour of a stronger sterling. So let's wrap up. We'll probably conclude from this that core inflation rates have peaked around the world and that a long, tough journey begins back to the 2% target of central bankers. Key risks lie to the upside in labour markets and particularly in the pricing decisions of corporations which are looking to maintain margins, so-called greedflation. It's enough, though, for central bankers to begin to pause, led by the Federal Reserve, to look over the impact of their longer-term tightening programmes. Yes, there's one or two more rate rises in Europe and in the UK, but the broad direction of travel is the same. For investors, it opens up opportunities in corporate bonds, and particularly for sterling investors, expect a steadily stronger currency. Thank you.